It's coming to the end of February 2023. 2022, towards the tail end, was marked by increasing interest rates caused by political disaster. Now, at the end of February 2023, I'm trying to think about where exactly interest rates will be a year from now. So to understand interest rate, you need to first know what interest is. Interest is the cost of borrowing money or the reward for lending money. It's usually expressed as an amount borrowed or lent. That's the interest rate. So in other words, the amount charged or paid for the use of money over a period of time. So if I give you £1,000 at a 5% interest rate, I'd expect £1,020 back in the period of time that I've agreed for you to pay me back in. So when you borrow money, you're charged interest, and when you lend out money, you accrue interest. So if you take out a mortgage, you'll be paying the bank interest, but if you put money into a savings account, the bank will be paying you interest. That's basically how interest works. So we know what the interest rate is. What changes the interest rate? What causes interest rates to go up and down, for example? And what causes central banks to change monetary policy affecting interest rates? The interest rate is typically determined by market forces such as supply and demand for credit, inflation, and the central bank's own monetary policy and strategy. There's also other aspects which feed into what we see as the borrowing rate for things like such as mortgages. So a mortgage particularly is affected by something called a swap rate. A swap rate is a rate of interest used in a swap agreement, which is a financial contract between two parties who agree to exchange cash flows. What this basically means is it's the rate banks pay for the money they give to you for your mortgage. So in a typical swap rate agreement, there's a fixed interest rate involved, and banks kind of make a profit margin on top of that swap rate. And what really affects things in the background, which are beyond the base rate, is stuff like market sentiment. So it's not really just what the base rate is today, it's where does the bank think the base rate will be in a year's time, or in 3 months' time, or in 10 years' time. And a good way of figuring out what the banks think is look at the products they're offering and the differences between the products being offered. Now, currently, I'm in the process of sorting out my own mortgage, so I've been doing this very closely. And there's a lot more to consider when it comes to this, but a lot of the time, just seeing what the banks are offering, because it's very similar across the board, can help you determine exactly where the interest rate will most probably go in terms of mortgages, at least. Okay, so let's look at mortgages. This is the website I usually use. Obviously, there's other websites, there's other places you can look, but I recommend just sticking it simple. I'm looking to buy, assuming you're a first-time buyer, to live in, first-time buyer, offer accepted, check mortgage rates available today. Let's keep it very simple. 200k property, 20% loan to value, 35-year term. Yes. Let's see where the 2-year fix are going. Add the fees to balance. If we ignore Platform, which is still a good lender, but let's just ignore them. Let's look at Halifax, NatWest, all of these places. So for a 2-year fix, you're looking at about a 5% interest rate. You could probably get this a little bit lower maybe, but realistically, you're looking at pretty much a 5-year. A 2-year fix, you're looking at 5% interest rate. So for a 5-year fixed, if we go to that, date that. For the 5-year fixes, you're looking at 4.5% pretty much roundabout. So it's 0.5% difference in interest rate, which is, close to £50 a month at this kind of price point. If you have a bigger mortgage, obviously, that's an even bigger saving. Interest rates hit you harder the more you owe. If you're going above the 5-year mark, the fixed rates, you get close to about 5% or more. It's a bit more random at that point. There's not as much consensus, but would I recommend doing a 10-year fix right now at historically high interest rates for the last 10 years? Probably not, but it's not the end of the world. It's probably still better than renting, if I'm honest with you. For a 200k property, you're probably paying about £1,100 a month in rent, and that's probably going to increase within the next 10 years the way buy-to-lets are going. So it's still not the end of the world if you end up doing this. You're not really losing out on much. So yeah, based on this information, the market sentiment is quite clear. Banks believe interest rates will remain high for around about 2 years, and then they'll probably go down, or actually over a 5-year period they can afford to lower the interest rate, which means in 5 years the interest rate will definitely be lower than it is now, according to bank. the interest rate is probably going to start dropping soon. So 2-year fixes are still not terrible. It's quite obvious that there's a certain agenda banks have, which is these 5-year fixes are what they're trying to get you to invest in, because even at the lower interest rates over that 5-year period, they feel like they can still make their money back. So yeah, personally, I'm opting for a 5-year fixed for multiple reasons. There's a lot of benefits to it just beyond the interest rate. The fact that you're paying a lower interest rate is great, but also the fact that it gives you 5 years to build equity in the property anyway before you have to remortgage. Because some people might not know this, if you actually get into negative equity, which is not impossible with the current housing market, you could lose the ability to remortgage at all. And if you do remortgage, it might be a lower loan to value. So you need to be very careful and very diligent when you make these decisions. You need to be risk averse, and sometimes a 2-year fixed might actually be more risky than a 5-year fixed, especially in the current market. People don't really consider that, but it is something to take into account. Okay, so the base rate, where's it going to go? Q1 2023, the base rate is currently at 4%. I believe it will increase in Q2 2023 or by Q2 2023 to about 4.5% at a minimum. I feel like it could even go higher because currently the inflationary increase hasn't really been tapering off as quickly as I think people expected. Now, by Q3, I feel like there'll be a lot more pressure on the Bank of England to really think about whether or not the base rate increases were necessary. There might be political pressure, there might be other issues which mean there will probably be a slight decrease in the base rate. Probably not as fast as people expect, but there will be a decrease. We'll probably be heading into a recession. 3 quarters of successive stagnation probably would have happened. So most likely the base rate will start to be lowered. After that, in Q4, towards the end of the year, it might be time for the Bank of England to start doing things which I guess stimulate the economy a bit more. We had a very, very poor 2022. 2023 is pretty much a write-off. Maybe going into 2024, the base rate will be lowered even more to 3.75%, might drop below 4% again for the first time in about a year. And from this point, I feel like in Q1 of 2024, it will be lowered again to around 3.5. Now, this does mean the base rate will trend down a little bit. I don't think it will be a decrease all the way down to 2 or 1% very quickly. Honestly, I don't think we'll see historically low base rate numbers below 1% ever again in our lifetimes, unless something crazy happens. However, anywhere between 2 to 4% is probably relatively healthy as long as inflation's under control, and it gives banks a good margin and allows for people to actually borrow without feeling like they're going to get screwed over. So I feel like that's where it's going to go. So I feel like the base rate in Q1 of 2024 will be about 3.5%. Now, no guarantees. This is just my own speculation from what I understand. A lot of things could change this. It could fall faster. It could keep rising, which is unlikely in my opinion. But it could fall faster than expected. It could go all the way down close to 3% by this time next year. However, I think that's unlikely. I think most likely we're going to see pretty elevated interest rates for at least another 12 months. The tapering off, in my opinion, will happen at the back end of 2024, where we might see things go below 3% again for the start of 2025. So this will be a long-term slog, but they will be coming down based on what the banks are predicting. So this is what I believe will happen as well. Obviously, base rate just informs mortgages. Mortgages might fall quicker. There might be other impact on mortgages, such as competition. It is a market after all, so who knows? But this is just my prediction. Hopefully that was helpful.